Turning to the macroeconomic environment, we see broadly the eye of the storm is broken. We are now starting to see the beginning, maybe of recovery, or we are at the tail end, and all projections are tending to indicate that things have peaked. As we can see, inflation has responded downwards. Projections that the U.S. Fed would start cutting the rates. It hasn't started. We're at the peak, but that gives us quite significant hope. When we come down to growth rates in the East African region, we see significant GDP growth momentum. This could not be true if then the tide has not changed. So we see the GDP projections to be very robust, averaging 6.4 for the entire region, and with some countries rising far beyond 6%. And that then gives us hope that the rates, if sustained, East Africa will become one of the fastest growing regions in the world. And we are glad to be that our home is in this region, that with growth rates above 6% as a region will be the fastest growing region in the world. And that gives us a very significant upside opportunity. And that's what we are working on. How do we unlock these? How do we become greater, more relevant in Tanzania, the way we have become in Rwanda, given the two among the top 10 fastest growing economies? How do we reshape our product house to be relevant to the youthful population, 63% of the population being below 24? And how do we align ourselves to the global aspirations that DRC, with its strategic green minerals, will play a very significant role? As we all know, insurance, given limited insurance position, is a huge opportunity. But looking at Equity Bank, we are very well strategically positioned because we are systemic. And as you can see, in most of the markets that we operate in, we are in number 2 position. When you're in number 2, you're not only relevant, you're systemic, and you can be a catalyst of cross-border trade. You can be a facilitator of interconnectedness, and you can be an agent for implementation of the African recovery, for the African Continental Free Trade Area. As we can see, the African thriving ecosystem of trade connections because of our sheer size. Our sheer size, position 2, has made us East African premier financial service provider, and in many perspectives. And we can be the driver of the East African growth story. That growth can happen on our rails. And given that we are well positioned either in capital, liquidity, risk buffers, we are in a position to be able to support that. And our 20 million customer base then gives us the opportunity to be able to drive a saving culture within the region. It gives us the capability to support that growth. So it's really financial ecosystems allowed the Equity brand and positioning our role within the East Africa of tomorrow beyond banking. We have been very strong in banking. We are very uniquely positioned. We are a unique financial services platform with a real good exposure into all and we have built the capability that would be enable us to be able to generate significant impactors in the region, and we'll play on our balance sheet and we'll optimize it, and we'll play on efficiency. And as we can see, it is really a story of looking at earning asset mix, NIMs, and return on asset, and looking at how we could play. So that then yields to individual countries, and I will not do a lot on individual countries, whether it's Kenya, whether it is Equity, BCDC. I'll give you this data to look at it, whether it's Uganda, whether it's Rwanda, whether it's Tanzania. There's sufficient data, including South Sudan, to give all of us an impression. The only thing I would then look is that the regional diversification of the banking business has worked very well for us. As we can see, profit before tax, the regional subsidiaries are contributing 63% of the entire profit. So the risk that was attributed, we were a Kenyan leader. We are now a regional leader with 63% of our profit coming outside the region. When we look at the whole balance sheet of the group, we see momentum. We are a liability-led organization, and we see customer deposit growth continues to be ahead. When we look at NPLs and quality of NPLs, we see, yes, because we are at the peak of the storm, it may be breaking. NPLs continue to be elevated, but we are confident that NPLs have peaked, and we'll see stability like we have seen in interest rates, and hopefully then we'll start seeing them slowly starting to come down before the end of the year. Treasury functions has become very important because of the size of the balance sheet. Nearly 30% of the balance sheet, next slide Alex, is in treasury. And so the efficiency of the treasury is critical, and we continue to see. As we said, the environment seems to start slowly changing, and we can see the volatility in exchange rates as reflected by mark-to-market losses. We have come from a dip of 78 billion. We're now down to 48 billion, suggesting that the tide have turned, and we believe it's just a question of time. As we can see, the group with its balance sheet size, it's also improving on the value chain, and if you look at trade finance, is now becoming a significant contributor to the balance sheet. So it's no longer the savings basic vanilla loan products. We're now able to do complex products like trade finance, and as we see off-balance sheet trade finance facilitation has attracted 205 billion, again showing that we are becoming a major trade facilitator bank. We talked about diversification beyond the region, but diversification of the business lines, and we see a strong start on the insurance business. We know the insurance opportunity is big, given that the insurance coverage has been pretty low. Our focus is on protecting life, protecting health, and protecting wealth. So it's a three-pronged approach because that's what we have been able to build. Our essence and purpose is to change lives, give dignity, and expand opportunities. And that is where the theme of the insurance business is coming from. Our second year of operation reflects very strong beginning, and we see the insurance business in its second year of operations taking very strong position. This is the life business, and if you look at gross written premiums, we've taken position 4 in the market with a 9% market share in the second year. And when you look at group credit, we have taken a position 2 with 18% market share and a number 1 return on equity. This is a startup on its second year, and it's the market leader in terms of return on equity, number 4 in profitability, and number 7 in market share. So insurance, as we can see, has moved pretty well.